the reason this game has been perpetuated so long is because it's the wholesale market that has been carefully managed. And this is why, if I as a wholesaler want to come in and buy $1 billion worth of silver, there's no way it would be. In fact, you'd just be point blank refused.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And today, a really special episode of the show because, well, I've had the fortunate pleasure of talking with Andrew Maguire once before. It ended up being the chapter for the book, so a lot of you haven't heard that or seen it yet, but especially with everything that is going on in the gold and silver markets, here we are, late May of 2020. Andrew, it is a pleasure and an honor to be chatting with you again, and lots to talk about. So, but before we get in, how are you doing, my friend?
Doing great, Chris. Obviously, I feel sorry for everyone that's locked down. I think that's, we're going to get through this thing. I'm not even going to comment on whether I agree with the lockdown, but essentially, we need to, let's talk about the gold and silver, the subjects we know. And by the way, let me just say, kudos on your book. What I've seen of it, it's an excellent resource, I think, for anyone that's wanting to lift the lid on this smoke and mirrors world of paper silver. So kudos to you. And, I have respect for anyone that's going to take on a subject like that and, all the things that go with that, including the risks. So excellent. Well done.
Well, thank you. That's very kind of you to say that. I'll say thank you. I don't know if that book would have happened if it's not for the things that you've done. And certainly, I don't know if it would have been the same without you. And so I'm honored to be a part of it. And I think there's potential for a lot of good, because one of the things that we'll dig into today, and I know that you're a part of, I wonder more and more if this really has to be the complete Armageddon that for years and decades it's been phrased as, where it's like without the dollar, we're all going to be shooting each other in the streets. And I'm thinking, geez, isn't this similar? Like if, one day the slaves, and I'm not trying to use this analogy lightly, but just when they realized they were making all this stuff, and if they just throw the slave master into the ocean, maybe life could be good on the other side of this with an honest system, of which you're part of with Kinesis money. And we'll dig into that. Although I think it's interesting. I see your trading screen to our right, the left of your head, and you can see something just plummeted straight down. And I'm going to pull up right here because it's interesting. Before we started, we can see today's silver price pretty thoroughly destroyed again. You saw it rallied last night. I'm wondering if this is what the Department of Justice would call a spoof, but how about I let you take it from there?
I think, Chris, while we're exiting this paper market system, and we'll talk a little bit more about that and who the players are, and of course your book covers a lot of who these players are, but essentially today what we're seeing, options expiration. These were bets made, let's just say 12 months ago and beyond, and into this year. And but I think the interesting thing about this is, whereas in March, when silver was smashed down to 11.5, or I think it was 11.60 or thereabouts, crazy, $5 down. That was because the option structure clearly showed that these same insiders that you talk about and that I'll talk about were actually in a position where they wanted that, they knew they could get that price down. Now, interestingly, since then, what we've seen is the speculators, and which is primarily driven by the algorithms and the way the algorithms work. I mean, basically, it's 95% algo, if not 98% algo driven, as you know. But there is such a thing as the majority of the algos are just neutral, and they'll just chase something in a direction, maybe you're taking a tick either side, but they're actually controlled by these high frequency trading bots, which is basically what the likes of what Bart Shelton talked about, which is the concentrated position holders who then take a hold of a high frequency trading bot and know exactly how to steer, like pulling somebody, like pulling you by the nose through these various structures, and chart painting silver into a price. Well, as I say, the interesting thing is at this point, it's the speculators who've become so accustomed to silver trading downwards or flat and capped that have actually sold what we call, and I know you know about options, and a lot of people know about options. So essentially, what if you buy an option, well, you're limited to the exact amount you bet. If you sell an option naked, then what you're doing is you're banking a price, banking something into your account, but you hope like hell that the level you've chosen, i.e., we've seen these guys selling strikes at $16, $17, $18, $19. And essentially, the closer, as price rises, the closer you get to those strikes, the more you have to either close those positions or buy futures to actually offset. It's called the delta hedging, as you know. So essentially, the difference between March and now is that we're seeing these same speculators who've been so accustomed to selling these naked calls against a price to gain a little alpha, thinking silver will never rise, are getting caught out. So yeah, we're seeing a little bit of a down market today. I say, in the bigger picture, that's a small move. And I think what's happening here is that we'll also look at the wholesale side of this. But essentially what we're seeing here is nothing but silver being weighed upon by officials and insiders to keep gold, which is definitely bearishly structured today for today's options expiry, at 1750. So really, that's what this is about. I mean, obviously they trade in tandem to a certain degree, but really it's all about gold today. Options and gold's in rollover. This is the June contract going into rollover. So really, it's just really about the futures contract, the SI contract, being weighed on a little to weigh on gold, which will this incidentally, we'll talk about gold in a little while, but I think perhaps we just keep on silver for the moment, because this is really fascinating. This past couple of weeks, we've been picking up, and I'm sure you've been following the same thing, and I'm sure your guests, and I think your guests have too, been picking up some very unusual SLV footprints, i.e. the ETF SLV. And there's been some elephant-sized footprints coming into SLV. And who's the custodian? JP Morgan. So interestingly, over the last 4 weeks, I mean, and these are big numbers, and they have to be put into context. These numbers can roll off your...
We talked about it on the show last night. The inflows are massive.
Yeah,
at least what they're reporting.
Massive. And the thing is so, sometimes we've seen in the past where silver inflows have actually seen a decline in price, as we did in March, but not this time. I think we've evidenced something like close to 1,400 tons of wholesale silver bars. Then last Friday, which is all sorts, we just had a holiday, didn't we? The UK was on holiday. There was no gold or silver fixes yesterday. This is the first real trading day of the month. And just as large wholesale bar shortages were stirring up questions in the key European silver trading centers, we saw a 58-ton SLV withdrawal, which is the first withdrawal actually for a while, almost certainly to meet some of this demand. Now, but Chris, as you know, this still leaves close to 1,340 tons of additions since the 24th of April, when spot silver fixed at 1531. And today, looking at spot silver, it fixed at 17,260. I'm not talking about futures. I'm talking about the spot fix. So many of these daily SLV inflows, and we've seen this. We saw last Thursday, we saw 246 tons coming in. And what happened? The price went down. Well, it's a lot of these inflows happen into intraday selling or capping in the equivalent SI futures contract. Now, hey, as you say, whichever way you look at it, I mean, nearly 1,400 tons of net inflows. It's a staggering amount of physical bullion. And given there is very limited physical size available for us wholesalers seeking to fill demand for full 1,000-ounce wholesale bars, which normally run at a 30-cent premium and are now really the premiums are through the roof. This can only be custodian JP Morgan, who just happens to be the largest single holder of physical for their own book. Now, I suggest they're gaining these flows, and to put things into context, trading banks or dealers requesting very large size, tonnage size of VAT-free wholesale bars, and that's important. They're met with warnings, or we are met with warnings, of being blacklisted from future dealings with the bank if you start coming in demanding and making a hullabaloo about trying to fill all your orders. Now, what is really not fully appreciated, and I hope we can bring this sort of wholesale view into what we're looking at, is that the largest stores of wholesale silver, such as UBS, sits in Swiss bonded warehouses, and VAT has to be paid. So this involves shipping it out, then importing it. That's not really a very attractive option, as it's possible to get caught out trying to avoid VAT. And you can get caught. I mean, at any point, a regulator could turn around, or a tax authority can turn around and say, no, we don't, that is not playing the game. You're not getting your VAT back. And maybe you can get a huge fine. It could be an enormous fine. So this means wholesale silver has to come from outside, and it's very limited in supply. And that's the point I'm trying to make. For example, today, as of today, Argor is being rationed to supply, rationed of supply, as is everyone. And that's UBS rationing supply to Argor. Now, current prices are just simply viewed as too cheap. And that's why suddenly not everyone's trying to say, look, let's get rid of all our wholesale bars. Goodness me. And given that SI is evidencing a radically different option structure, which is what we just talked about, versus the one that we saw when silver went down to 1160, what we're saying is here that it is JP Morgan going long SLV for their own book. Now, this is quite a big deal, and it makes no sense unless you look at the actual numbers. I mean, no other entity has a sufficient volume of physical silver to sell into the trust. So an SLV investment of this size would give them a massive opportunity to capitalize, and this is the key, on closing a plus 50-cent spot discount to futures. Now, if you look, and I know that Eric Sprott was talking about this, Toad Ferguson was talking about this, it's absolutely, I can verify, it went up to 58 cents today at one point. I mean, why would that not be an upside arbitrage profit? Of course, it would be simply closed. And the fact that this arbitrage gap has not been closed this week, and the fact there is a very visible algo that has kept SI trading at an average to 50 cents to spot, it telegraphs this is the case. Or by now, JP Morgan would have used their enormous physical position to short SI futures and close the gap, just as they did in March. So some big differences, because in March, insiders, as I say, were bearishly structured, and that is and gained through this $5 SI discount. So that's not the case. Here in May, these SLV additions, as they pour in, we're evidencing that it is the specs who are carrying the bulk of the naked short bearish bets, June and July OPEX bets. And they are extremely vulnerable to an upside rinse. And I'm sure nobody watching this podcast, this webinar, is actually going to be short of silver. I would really doubt it, unless you have enormous physical holding and you need to perhaps hedge that exposure, but it's so unlikely given the current footprints. So, pulling off a future short sell into the current bullish bearish option structure is clearly no longer desirable. And given the undeniable wholesale silver shortage, there's so much more profit to be made by loading up SLV at a 50-cent discount to futures, because SLV is priced at spot, and maintaining the futures premium while rinsing out spec naked short bets and then closing the spot to futures spread, revaluing a massive long SLV position 50 cents higher. And if you want to think about the numbers that this kind of spins off, I'm just talking about in the last 3 weeks, where we saw 44 million ounces of SLV additions. I mean, a 50 cents revaluation of that's 22 million risk-free profit when this 50-cent gap is closed. So keep in mind that no physical ounces would have to been sold from JP Morgan's concentrated physical holdings, and they will just be converted in the form of ETF shares. And then of course JP Morgan will sell their they're never going to sell these, let's call them ill-gotten physical silver position, which they've managed to accrue by gaming the paper markets so incredibly strongly over the last few years. This position is far too valuable an asset for deeply underpriced silver.
Yeah, a lot of really interesting things you mentioned there, Andrew. One that I might just like to point out to folks, what you were saying about the options, this isn't your opinion. And this was actually even mentioned in one of the JP Morgan confessions. Forget exactly which trader it was, but they talked about barrier options and how they would push something towards the strike. And just looking at the way this dive bombed, my guess is without even having looked at it, you'd probably imagine the banks were short calls and puts around the 17 strike, and whoever would make a fortune on that one. Although Andrew, you also mentioned that great call with Eric Sprott and Craig Hemke on Friday. We'd love to get your thoughts on that, where Eric Sprott said that large dealers are calling him and saying, hey, do you have any silver bars, 1,000-ounce bars? Which, along the lines of what you've been saying, and what I think a lot of people are wondering, how close are we to that break point where someone on a wholesale level shows up and says, here's my contract, I want delivery, and it's not there. Again, from an outside perspective, seems like there's a lot of smoke around the fire, but again, I'd love to hear what you're seeing on that one.
Right. Well, I think again, the reason this game has been perpetuated so long is because it's the wholesale market that has been carefully managed. Now, you can go on the retail sites and you'll see massive premiums for silver on a retail basis, and coins, et cetera, but really it's about controlling the wholesale business. And this is why, if I as a wholesaler want to come in and buy $1 billion worth of silver, there's no way it would be. In fact, you'd just be point blank refused. And really, if you think about it, over the years, by keeping this wholesale balance, call it a balance, it's almost disingenuous to even call it a balance, but essentially to keep this flywheel running, perhaps is the best way to put it. You need to ensure that the Samsungs of this world, the Apples of this world, the Nokias of this world get their gram of gold for each product, or the amount of silver, for each product. And so that they don't suddenly panic, and you can't stop an assembly line. So what you would do is make sure they always get their wholesale silver on time, and so they don't suddenly come out and buy huge amounts of it to protect their assembly line. So there's one thing over the years that we know this wholesale market has been managed very, very carefully. But we reached a point now where it's so cheap compared to gold. I mean, ludicrous. I mean, I know you've had guests on and you've talked about it, so I won't belabor it. But what, 128 to 1? I think Alistair McLeod mentioned it the other day. Yeah, that's amazing, amazing leverage. When historically we should be talking 15 to 16 to 1. Well, you know, basically, silver, even now as a paper instrument, it should be around about 60, and I'm not saying that's fair, should be around 60 to 1, 63 to 1 maybe. Ideally, 30 or 35 to 1. I mean, where do you think that puts the price of silver today based upon, you know, 1,700 odd gold? So it's ludicrous, and it is so undervalued. And we've suddenly seen, you've noticed yourself, the ratio trade suddenly diving. Suddenly SLV picking up inventory, tight supply. So to answer your question, these guys are right on the button. Yeah, there is no wholesale supply. So yeah, you'll get, but kilo bars, we're waiting till July for kilo bars. But kilo bars is not the wholesale market, and they're always limited in supply. So really, it is about these 1,000-ounce bars and how many you can get, how many you're restricted to. And now we find the refiners, as of today, being restricted by UBS in particular to Arcadia, for example, today. So that's a good example of how tight things are.
So there is part one of the interview with Andrew Maguire, certainly beyond stunning what he shared. And if you like that, you are definitely going to want to come back tomorrow night when part two is released. So go ahead, hit that subscription button and the notification bell so you can stay posted when new episodes of the show are ready to come your way. And thanks as always for watching.